CIMB Group Holdings saw its fourth quarter FY18 net profit improve by 5.4% to 1.12 billion ringgit as both its commercial banking and group funding businesses did better. Revenue for the quarter declined by 9.8%, however, from 4.52 billion ringgit to 4.07 billion ringgit. The bank proposed a second interim net dividend of 12 cents per share. This brings FY18's total dividend payout to 25 cents per share. On a full-year basis, CIMB reported a record net profit of 5.58 billion ringgit, which was 24.8% higher than in FY17. Top line for the year declined by 1.39% to 17.38 billion ringgit. Group CEO Tunku Datuk Sri Zafrul Aziz says the bank is targeting loan growth of 6 to 7% for FY19 versus consensus forecast of 5% as GDP is expected to grow 4.5% in 2019. He adds that this will be mainly driven by Malaysia and Indonesia. For FY18, the bank's loan growth came in at 7%, which exceeded its earlier set target of 6%. Zafrul says in comparison, the banking industry grew by 5.5%. Moving forward, the bank says it remains cautious in 2019 in view of sustained external headwinds as well as political developments in Indonesia and Thailand. FGB Holdings swung into the red in both its fourth quarter and FY18 on impairments, provisions and lower CPO prices, although it promises that improvements will be more visible this year. For its latest quarter, it saw a net loss of 208.8 million ringgit compared with a net profit of 50.4 million ringgit previously. Revenue slipped 24% to 3.23 billion ringgit. Meanwhile, the full fiscal year had FGB slumping to a net loss of 1.08 billion ringgit from earnings of 130.93 million ringgit in FY17. Top line shrank by 20.4% to 13.46 billion ringgit. FGB Group Chief Executive Officer Datuk Haris Fazila says in the fourth quarter, the group's plantation operations were focused on plugging leaks, revising processes and implementing new controls to bring its estate performance in line with other large players in the industry. The result of these efforts will show up more clearly in 2019, with FFB production expected to improve this year, as well as higher domestic consumption from a stronger biodiesel mandate in Indonesia and Malaysia. Tenaga Nasional saw its net profit for FY18 jump 42% to 3.72 billion ringgit from the 2.62 billion ringgit reported in the previous year's corresponding period. Revenue for FY18 more than tripled to 50.4 billion ringgit. However, the national power provider posted a net loss of 134.3 million ringgit for the fourth quarter of FY18 on the back of 12.5 billion ringgit in revenue. Due to a change in financial year, there are no comparable figures available. But when compared with its preceding quarter, fourth quarter's operating profit came in 777.5 million ringgit lower due to lower revenue and higher impairments. This is TNB's first quarterly loss since 2011. TNB has proposed a final single-tier dividend of 23 cents per share. The utility expects the Malaysian economy to remain on a steady growth path, with private sector demand to likely be the main driver of growth. As such, TNB expects electricity demand growth and the group's performance to remain stable in FY19. Sime Darby Plantations' net profit for the second quarter of FY18 plunged 70% to 129 million ringgit from 429 million ringgit in the preceding year on the back of lower CPO and palm kernel prices. Revenue also decreased 14.2% to 3.5 billion ringgit from 4.09 billion ringgit. Sime Plant says the lower prices affected the performance of all its upstream segments. On top of that, the group also saw higher finance costs due to higher level of borrowings undertaken during the second quarter of FY18. However, this was cushioned by better earnings improvements in its downstream segment, as well as non-recurring gains from the disposal of its Liberian and Vietnamese subsidiaries. The company declared a final single-tier dividend of 1.7 cents per share. Executive Deputy Chairman and MD Tan Sri Muhammad Bakir Saleh says the first 6 months of FY18 was challenging due to Europe's negative stance on palm oil, lower CPO and PK prices, as well as pressures from the US-China trade war. However, Bakir says on a brighter note, the industry is off to a reasonable start in 2019 as CPO prices rebounded due to declining inventories and a drop in India's import duties. DRBHicom swung to a third quarter net profit of 73.02 million ringgit from a net loss of 70.03 million ringgit a year ago, while quarterly revenue rose 9.3% to 3.17 billion ringgit. This as it sold more Proton cars thanks to the popularity of the X70 and completed more AV8 military vehicles. Its banking and waste management businesses also did better. However, this was offset by the lower revenue recognized from construction-related projects. For the 9-month period ended December 31st, 2018, the group posted a net loss of 5 million ringgit, down from a net profit of 489.78 million ringgit a year earlier. Revenue slipped 2.8% to 9.01 billion ringgit versus 9.27 billion ringgit last year. DRBHicom explains that the previous year's results had included that of the Lotus Mark, which it had disposed of in September 2017. It expects operating results for FY19 to be better than FY18's financial performance, excluding exceptional items.